Hey there, folks. Let me tell you, the stock market's been a wild ride lately. Social media is buzzing with anxiety, and new investors are understandably nervous. Headlines scream about crashes and corrections. It's enough to make anyone want to bury their money in the backyard. But hold on a second. Before you start digging, let's break down what's really going on. The market's down, no doubt about it. But remember, volatility is part of the game. It's like a roller coaster. There are ups, downs, and sometimes even loop-the-loops. The key is not to panic. Instead, let's understand the forces at play. We'll separate the facts from the fear-mongering. Once we do that, you'll be in a much better position to make smart decisions about your money. So take a deep breath, grab your favorite beverage, and let's dive in. One word's on everyone's mind: recession. It's the big, scary R word that sends shivers down investors' spines, and frankly, there's good reason for concern. The economy's facing some headwinds. Inflation's still stickier than a marshmallow in a candy jar. The Federal Reserve's raising interest rates like it's going out of style, trying to tame those rising prices. And global uncertainty, fueled by events like, well, you name it, isn't helping matters. But is a recession a foregone conclusion? Not so fast. Remember, the economy's a complex beast. There are a lot of moving parts. While some indicators flash red, others remain surprisingly resilient. We'll delve into those indicators in the next few sections. We'll examine historical parallels, analyze the Fed's moves, and explore the impact of global events. By the time we're done, you'll have a much clearer picture of what's really going on. Whenever the market takes a tumble, it's natural to look back at past crashes and wonder, are we in for a repeat performance? The 2008 financial crisis and the 2020 pandemic-induced recession are still fresh in many investors' minds. And yes, there are some eerie similarities. The subprime mortgage crisis that triggered the 2008 meltdown was a classic example of excessive risk-taking in the financial system. Today, we see potential bubbles in areas like tech stocks and cryptocurrencies. Similarly, the 2020 recession was swift and severe, driven by an unprecedented global shutdown. While we're not facing a pandemic of that magnitude now, supply chain disruptions and geopolitical tensions are creating their own brand of economic uncertainty. However, it's crucial to remember that history doesn't repeat itself verbatim. The economy has evolved since 2008. Regulations are tighter, banks are better capitalized, and policymakers have learned from past mistakes. Now let's talk about the Sahm Rule. This economic indicator, named after economist Claudia Sahm, has been making headlines lately. It suggests that a recession is likely when the 3-month moving average of the unemployment rate rises by half a percentage point or more relative to its low during the previous 12 months. The Sahm Rule has a pretty good track record of predicting recessions. However, like any indicator, it's not foolproof. This time around, there are reasons to believe it might be flashing a false alarm. The labor market remains incredibly tight. Businesses are struggling to find workers, and wages are rising. This suggests that the economy still has some underlying strength. Of course, the unemployment rate could tick up in the coming months, but even if it does, it doesn't necessarily mean we're headed for a full-blown recession. We need to consider other factors, such as consumer spending, business investment, and global economic conditions, to get a complete picture. The Fed's balancing act: interest rates and market jitters. The Federal Reserve, the big kahuna of monetary policy, is on a mission to tame inflation with interest rate hikes. Raising rates makes borrowing more expensive, cooling the economy to control inflation. Simple, right? Not quite. The Fed's walking a tightrope. Raise rates too quickly, and it risks triggering a recession. Raise rates too slowly, and inflation could become entrenched. The market hates uncertainty, and there's a lot of it surrounding the Fed's next move, so buckle up because the ride's likely to be bumpy for a while. Tech titans stumble. The Magnificent Seven's impact on the downturn. The tech-heavy NASDAQ has taken a beating this year, and that's bad news for the overall market. Why? Because a handful of tech giants, often referred to as the Magnificent Seven, carry a disproportionate amount of weight in major indexes like the S&P 500. These titans, Apple, Microsoft, Amazon, Alphabet, Google's parent company, Meta, Facebook's parent company, Tesla, and Nvidia, have been on a tear for years, their stock prices soaring to dizzying heights. But lately they've come down to earth with a thud. Several factors are weighing on tech stocks. Rising interest rates make it more expensive for these companies to finance their growth. Supply chain disruptions are hurting production, and concerns about slowing economic growth are dampening investor enthusiasm. The Magnificent Seven stumble has a ripple effect on the entire market. When these heavy hitters fall, they drag down the indexes they're a part of, and that can create a negative feedback loop, leading to further selling pressure. The yen's ripple effect, unraveling the Japanese loophole. Believe it or not, what happens in Japan doesn't stay in Japan. The Japanese yen, the third most traded currency in the world, has been on a wild ride lately, and that's having ripple effects across global markets. Here's the deal. Japan's central bank has kept interest rates ultra low for years, trying to stimulate its sluggish economy. This has created a carry trade opportunity for investors. They borrow cheaply in yen, then invest that money in higher-yielding assets in other countries. However, with inflation ticking up globally, Japan's central bank is facing pressure to raise rates, and that's where the loophole comes in. As Japanese interest rates rise, the yen becomes more attractive to investors, causing its value to appreciate. This can create headaches for global investors. Why? Because a stronger yen makes Japanese exports more expensive, potentially hurting global trade. It also reduces the returns on investments denominated in other currencies. The yen's gyrations are just another example of how interconnected global markets are. What happens in one corner of the world can have far-reaching consequences. Weathering the storm strategies for new investors. All right, enough doom and gloom. Let's talk about navigating this turbulent market. If you're a new investor, it's understandable to feel overwhelmed. But remember, volatility is part of the game. Stay calm, stick to your plan, and focus on the long term. Don't panic sell. You only lock in losses when you sell. Believe in your investments and ride out the storm. Revisit your risk tolerance. Adjust your portfolio if needed. Remember, time is your friend. The market rewards patient investors. Focus on long-term goals to weather any storm. Buy the dip opportunity amidst the chaos. Now, while it's important to stay calm during a downturn, it's also a time to look for opportunities. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." When the market drops, it's like a department store having a massive sale. Stocks that were once out of reach become more affordable. This is where the buy the dip strategy comes in. The key to buying the dip is to be selective. Don't just buy anything that's down. Focus on companies with strong fundamentals, solid track records, and good long-term prospects. These are the businesses that are most likely to rebound when the market recovers. Remember, buying the dip isn't about timing the market perfectly. It's about taking advantage of market volatility to acquire shares of great companies at discounted prices. Dollar cost averaging, your secret weapon against volatility. Here's another powerful strategy for navigating volatile markets: dollar cost averaging. This simple yet effective technique involves investing a fixed amount of money at regular intervals regardless of the market's ups and downs. Here's why dollar cost averaging works. When the market is down, your fixed investment buys more shares. When the market is up, you buy fewer shares. Over time, this strategy helps you average out the cost of your investments, reducing your overall risk. Dollar cost averaging takes the emotion out of investing. You're not trying to time the market or predict the next big swing. Instead, you're consistently investing, regardless of what the market is doing. This strategy is particularly beneficial for new investors. It allows you to build a diversified portfolio gradually, without having to invest a large sum of money all at once. Stay focused, long-term vision in a short-term world. As we've seen, the stock market can be a wild ride. There will be ups, downs, and everything in between. But through it all, the most important thing is to stay focused on your long-term goals. Don't get caught up in the day-to-day noise. Tune out the fear-mongering headlines and the social media panic. Remember why you invested in the first place. Are you saving for retirement, your child's education, a down payment on a house? Keep those goals front and center. When the market takes a tumble, remind yourself that these short-term fluctuations are just blips on the radar screen of your long-term investment journey. The stock market is a powerful wealth-building tool, but it's a marathon, not a sprint. By staying disciplined, patient, and focused on your long-term goals, you'll be well positioned to achieve financial success.